Okay, everybody, it's me, Gregory Mannarino. It is Friday, August 19, 2022. People, are you watching what is happening globally this morning with regard to the bond markets of the world? Well, something is happening here and the market already doesn't like it. What am I talking about? Well, bond yields are rising. All right. Here in the United States, 10-year yield 2.96. I've been telling you for weeks now. The market doesn't like seeing this action in the debt market where the 10-year yield was hovering around 2.87 now. We're at 2.96. We watched this happen several months ago where global bond yields were rising. European Central Bank set off on their extravaganza to buy more, buy it all, unlimited, across the entire Eurozone. Fed followed suit here, and now we're seeing this phenomenon occur again. Now let's just go back to the video I did yesterday. I explained to you that if the 10-year yield were to drop, and I still believe it might here, but we need to see how this plays out, that the stock market would go much higher. Realize what I'm about to tell you again, especially if you're new here. The global equity markets or the global stock markets, okay, are 100% dependent on what is going on with regard to bond yields around the world. More specifically, the 10-year yield here in the United States, okay? So what does that tell us? What have I been telling you for years? The stock market then becomes a derivative of action in the debt market, meaning, well, the stock market and pretty much everything else derives value from what is happening in the debt market. Let's look at a couple of other things right now. Bond yields rising around the world. U.S. 10-year yield 2.96 last time I looked at it. You got a sell-off here in cryptocurrencies. You got gold and silver under pressure. You got crude oil under pressure here. Looks like a pan sell-off to me this morning. Again, it's because the debt market has been showing signs of instability now ever since, well, just prior to the European Central Bank making their monumental announcement that they were going to buy it all, unlimited bond buying across the entire Eurozone. So the market doesn't like it. The stock market doesn't like to see instability in the debt market. We already have a yield curve here that is the most inverted in history, okay? A clear sign that, well, we're already in recession now. No one's going to admit it, especially Janet Yellen, President Mummy, man, everything is fine, it's great, of course, it's a freak show, and you all know that. Fact of the matter is, we are in a deep recession already, and it's going to get a lot worse moving forward here. Clearly, look, based on what I look at, and I follow this stuff every single day here, not only are we moving into a severe, I'm going to use JP Morgan's words here, a severe recession. It's going to be a depression here. We just found out, and you look this up for yourself, 50% of U.S.-based companies are going to be laying people off moving forward here. This issue with inflation, well, we just found out this. In Europe here, inflation is surging faster even than it's surging here in the United States. And they're selling you the lie, the propaganda ministry. Oh, inflation is transitory. It's peaking 1 or 2 times. Oh, they're showing signs that it's easing. The Fed's going to raise rates aggressively because they really want to combat inflation. No, central banks, along with puppet governments around the world, none more so than here in the United States with Mummy Man here, I'm talking about President Bidenstein, is doing everything in their power to make sure that inflation keeps getting worse here. Okay, you can't just create hundreds of billions or trillions of dollars out of thin air and expect there not to be a consequence for it, but that's what they want you to believe. Oh, it's fine. We're going to spend hundreds of billions of dollars to reduce inflation, but all it's going to do is make inflation worse. All of these things that are going on here, people, you all know that. I think you do, at least I hope so. So the phenomenon here is interesting because we witnessed this just before the big sell-off in the debt market, which forced the European Central Bank to take action, Federal Reserve to follow suit. Okay, so what are they going to do? In my view, they're not done. Could they be done? Maybe, but I doubt it. We're going to know relatively soon. I mean, we're going to know relatively soon. If we see, you and I, witness this 10-year yield start to spike in an uncontrolled fashion yet again, and it doesn't stop, it's over. I mean, it's absolutely over. Meltdown in the debt market is going to melt down the stock market. Okay, so cash leaves the debt market, cash leaves the stock market, and it doesn't float away. It doesn't just grow little money wings and grow off and fly off to money heaven. No, it's going to move. It's going to move, in my view, into commodities and probably into cryptocurrencies as well. Commodities is where you need to be in a full-on meltdown situation of the debt market. Because again, think about why I am saying this. Okay, what do we know has been going on since the last meltdown? Well, artificially suppressed rates have caused cash to move into housing, which I did a whole video on this yesterday, seeing cracks in this housing bubble, no doubt about it, in my view at least. And it looks like a lot of you agree with me reading the comments from yesterday's video. If you haven't seen that video, please look at it. So meltdown here, debt market will crush the stock market. You're going to see rates spike, reverse of what quantitative easing has done, and cash, again, is just going to move into real things. In my view, the most undervalued commodity on earth is physical silver, gold, platinum, palladium as well. I think these things have the potential to surge, absolutely surge. That's my take on it. You are entitled to your own take, but just think about what I'm saying. If we realize that cash just flows through the market into different asset classes, where's it going to go? If you have a bleed off here of cash in the debt market, crushing stocks, in my view, it's going to go into commodities. These are real things. And you're going to see inflation like you cannot possibly believe. It's going to make what's happening now look like a walk through Central Park eating an ice cream cone. You understand? Seriously. So be ready for that. Be ready for that to happen, people, because look, I don't think there's anybody putting this scenario together like that, realizing that the stock market is a derivative of the debt market. Debt market implosion will destroy the stock market, and cash is just going to move into hard assets, into commodities, into real things. Does that make sense to you? First question during this video. What I just said, did that make sense to you? Or do you see another scenario? Let me know what you think. Believe me, I'm not too old to learn a new trick here. So comment. Let me know what you think. This is why I've been advocating to hold severely undervalued assets. I'm referring to gold, especially silver here. Anyway, that's the way it looks to me moving forward. So this morning, that's the big thing. For everything else is just, theater in my view here. Realizing that central banks have gone out of their way to obviously inflate a financial monster, Frankenstein, and that is the hyper bubble in debt, which has created bubbles to the upside, inverse bubbles, gold and silver in my view, and an inverse bubble. You all know that. I've been talking about that for years. There's no price discovery mechanism, distortions across the entire spectrum of asset classes, unlike anything we've ever seen in the history of the world. Now, this issue with bond yields globally right now rising, 10-year yields making a pretty big jump overnight. Let's keep our eyes on that. Watch the MMRI, people. Right now, we are just under orange, which is not looking too good here. Mannarino Market Risk Indicator. Link in the description of this video. So if you don't want to watch the 10-year yield or you don't understand it, that's fine. Watch the MMRI, which looks at the debt market as a whole, including the dollar, okay, which is a unit of debt. It comes up with a neat little equation. It comes up with a number, and that number is color coordinated. I think look, I'm not tooting my own horn here. It's my creation. But I think it's freaking ingenious. I don't believe that there is a better risk indicator for this market anywhere in the world. You're not going to find one. And it just works. So go check that out. Link in the description of this video. So that's really the story. So you got 50% of U.S. based businesses planning to lay people off here. Imagine my shock. Energy prices continue to rise despite what we're seeing here in crude oil recently, and that will not last beyond the midterm in my view here. Still, crude oil has no business being here. It's all just artificially propped up. I think we all understand that. It's pretty straightforward. So as I said, stock futures are lower, pointing towards a lower open on the back of this 10-year yield spiking. No surprise. If it continues to spike, we know it's over. Look, you and I, we don't have to guess when the big one is going to occur here. Corrections in the market happen 20, 25%, even more can happen in a normal market. Okay, people were freaking out over the last several months as the market was going down. Oh, this is a crash. This is it. Meanwhile, what was happening to bond yields? They were low ever since ECB jumped in, buying it all. Fed followed suit. It's easy to see what's going on here, people. The big one, the big stock market crash is not going to start in the stock market. It's going to start in the debt market because it's the driver. Okay, stock market is a derivative of debt market action. So there's no guessing on our part. We will know by following the 10-year yield, by watching the MMRI, when the big one's going to hit. And this stock market could fall 80%. I'm referring to the broader market, the S&P 500. When that happens, it's going to happen. It's just a matter of when. You understand? All right, look, I covered a lot of things here. I hope you have a handle on this here. I did cover cryptocurrencies, which are under pressure. Gold and silver under pressure. Crude oil looks like a pan sell-off. Like I said, a pan sell-off meaning everything. All right? And it's all predicated on bond yields around the world, which are rising today. 10-year yield, 2.96. Let's see where that goes today. All right. I will see all of you at the end of the day. Please comment here. What do you think about what I have covered? Makes sense to you? Doesn't make sense to you? All right. Let me know where you're at. I will see all of you at the end of the day. I'm out of here.